Olá, muito bom dia a todas e a todos que nos acompanham neste último dia do International Conference Accounting, 21ª edição do Congresso USP, 18ª edição do Congresso de Contabilidade e Iniciação Científica da FEA USP. Eu gostaria inicialmente de agradecer aos nossos patrocinadores, PwC, Grupo Gen Atlas, KPMG, Concefaz e Traders Club. Nessa manhã, nós recebemos o professor John Campbell, who will talk about how financial reporting research can inform educators, regulators, and practitioners. Professor John Campbell is Professor of Accounting and Coordinator of the PhD program and UI Faculty Fellow at the JM2 School of Accounting at the Terry College of Business at the University of Georgia. Professor John is Bachelor of Science in Analytical Finance and Master of Science in Accounting from Wake University and PhD in Management from the University of Arizona. Since 2010, he taught financial accounting to undergraduate, master's, and doctoral students at the University of Georgia. He was won numerous teaching awards and scholarships at department, college, and university levels, including the Teacher of the Year award numerous times. Being selected for the Lilly Teaching Fellows program, which is awarded annually to 10 professors across the University of Georgia. Previously, he was a professor of financial accounting at the University of Arizona and Wake Forest University. He serves as an editor at Contemporary Accounting Research and on the editorial board of the Account Review and the Journal of Business, Finance, and Accounting. Before the academy, Professor John has worked as a merger and acquisition analyst at Wachovia Securities, was a senior auditor at PwC, and is a financial statement manager at Hamilton Arms Company. I will be the moderator of this presentation. Please, Professor John Campbell, the floor is yours. Thank you so much for staying here with us today.
All right, thank you, Eduardo, for having me. Let me put the slides up here and say thank you for the opportunity to present. I was in Brazil about 2 years ago teaching a course at FGV and had the opportunity to meet Eduardo and get a sense of the very good work that's being done there in Brazil on accounting research. And so I'm just pleased to be able to meet you all today in a similar way. So let me go ahead and start the talk. Basically, the title, as you can see, is how financial reporting research can inform educators, regulators, and practitioners. Let me first just tell you up front, my goals are to introduce myself, to talk about how I think academic research can lead to better teaching, how I think academic research can inform regulators about what they do, and how academic research can inform practice, and what is done in the quote unquote real world, which we like to talk about and think about, and our students go out and participate in. So why am I here to talk about this topic? It's somewhat related to what Eduardo said at the outset. I've in terms of research, I've worked as a research professor for the past 14 years, during which time I have interacted heavily with the regulatory bodies in the United States, the FASB, the Financial Accounting Standards Board, and the Securities and Exchange Commission, the SEC. And before that, as Eduardo said at the beginning, I worked as an investment banking analyst, an auditor, and a preparer of financial reporting. So I think I have some practice, with, the real world. And I currently do accounting training for investment banking hires. So the point that I'm trying to make with this initial slide is not to tell you about all the things I've done, only to say, I think I have some unique perspective on what accounting research is and how it could be used by educators, regulators, and people in practice. So, but let me first define what I mean by academic research, especially because the title here is financial reporting research. And I just want to say that's a very broad topic. So basically what I'm speaking about when I say financial reporting research is positive accounting research. So that that is very, basically, if you were to look in the United States around 1980, Ross Watts and Jerry Zimmerman wrote a book that was called Positive Accounting Research. And the point is, up until about, the 1968 or so, most accounting research was, well, earnings should be accounted for this way, or no, I disagree, it should be that way. And a lot of it was how things should be, very, very normative, very descriptive, prescriptive. And then they said, look, that's not the point of science. The point of science is to describe things the way they are right now, not how they should be. And then you can decide what you want to do from there. And so that's what I mean by research, is just to look at how things are working right now, not a piece about how they should be working. And so then also, in my mind, research applies statistical techniques to financial data to, again, examine how things are working. And by statistical techniques, I mean some methodology, to examine if, usually regressions or some statistical methodology to examine if a change in X leads to a change in Y, okay? And X and Y can be anything. And data, can be either financial data reported by firms, which we would call archival data, or it could be, created by researchers, which we would call experimental data. Both of those things, I think, fall under the umbrella of what I'm defining. So again, what I'm talking about in this presentation is financial reporting research, the goal of which is describe things as it is, not how it should be. And it uses statistical techniques on data, data that's reported by firms or created by researchers, all with the goal of trying to determine, does accounting disclosure or variable X lead to outcome, Y in the capital markets? And that's the point. And so the earliest example of this really was, Ball and Brown 1968 and Beaver 1968. These were the first sort of positive accounting papers, research papers. And the way they came about was these guys, all three of them, Ray Ball, Brown, and Bill Beaver, were all at the University of Chicago. And the finance faculty at the University of Chicago said, why do we need accounting? Like, accounting is useless. It comes up with this number called net income, and I don't even know what to make of it, because you've got revenues, of course, then you've got cost of goods sold, you've got SG&A expense, but then you've got like this thing called depreciation, and like, how do you come up with that? And it's like you're subtracting sort of like this, like, real expenses and arbitrary non-cash expense, like, and what is this net income supposed to even mean? I don't get it. And also, by the way, when it comes out, it's usually like super late in the game, because we already knew what revenues were going to be before the 10K comes out, or the end of the year audited financials come out. It's late. And we probably would have, the finance guys were like, we knew about this because the press told us that their revenues were good. So basically the point was, accounting is meaningless. And these guys said, okay, well, we can test that. We can find out whether that's true. You think that, let's see what the market says, and the way to do that would be to say, look, when the earnings are announced in the account, when net income is announced, if it doesn't mean anything, nobody will react. But if it means something, people will react. And then the other thing was, so that's one thing is, two things. Number one, if net income isn't important, then the stock prices won't move in relation to it. So that's the first thing. The second thing is, when it comes out, do they react? And so that was what happened. And so you can see here, they created these nice, pretty graphs, these pretty pictures. But the first one here, if you can see my arrow, this is Ball and Brown. And what they did was they just said, look, they created sort of what they called earnings, abnormal earnings. And they basically, so abnormal performance index is what they called it, API. And they just tested whether it was like abnormally positive or abnormally negative. And this time zero here is when the year was over, okay, when the end of the year. And they said, look, if over the year you're going to have like positive news in your account, in your net income, then during that year you see a positive reaction in stock prices. So earnings must reflect something that people care about in the stock market. So these finance professors that said it's meaningless, apparently it's not, because the market does move in the way that the earnings move. And the same thing with a negative earnings surprise. If the news was going to be negative, stock prices went down. Now, that's just to say that during the year that the market did move in the same direction as earnings, but it doesn't say whether people reacted to the earnings, right? It just says the earnings are useful, but it doesn't say that the stock market uses net income. And so, but then after time zero, when they come out, you can see there is still a little bit more reaction. And I think in that paper, they said about 80, it is true, about 80% of the news that earnings reflect is already in stock prices before it comes out, but 20% is not. And so that's why it's still useful. And then this is Beaver's paper, and he just looked at trading volume and found it, did a tighter study and found that, look, during the week that earnings are announced, you see a lot of trading going on. And so this is consistent with, not only do earnings reflect value relevant information, they also reflect new information investors didn't know about that they're willing to trade on. And so this collectively was kind of the start of this idea of positive accounting research, where we would say, let's describe the world the way it is. So people that have conjectures about the world and that net income doesn't matter, or that accounting is worthless, or that we can just see what the data says. And that's what they did. And so then that really kind of spawned a whole lot of research. That from that point, in the 1960s, we started with the question. Sorry, by the way, this is handwritten. This is something I did on the back of a research paper when I was describing to my wife what we do at research. And at some point I will make it more formal, but like the point is, this is how, in my mind, this is how research has changed since the 1960s. We started with the question of, do earnings matter? Which I just told you the answer was yes. They appear to convey value relevant information, and they appear to convey new information. Okay. Then the question that we tackled in the 1970s and 1980s was, okay, well, when do they matter more or less? So we started looking at cross-sectional variation in that answer. And we found that, look, earnings are more useful when they're more persistent. So they're not as, volatile. When the firm has more growth opportunities, and they're less useful when the firm is riskier. And then they're most useful early in the life of a firm because we don't know as much about them. And so anyway, but this was the next thing. Then we said, okay, now that we know when earnings matter more or less, let's look at the components of earnings. So net income is the bottom line, but you got a whole income statement, right? So like, what about other line items? What about specific expenses? What about sales? What about different ways to report earnings, like GAAP or non-GAAP earnings? And so that was like a thing we started doing in the 1990s. And then also we started thinking, okay, well, if earnings are useful right now, can they tell me something about the future? So can I predict stock returns? Can I predict future outcomes? And this led to a lot of research on forecasting and financial statement analysis. And then listen, earnings is not just there to play an informative role. It can also play a confirmatory role, meaning it disciplines the manager if they know that whatever is they do is going to end up getting audited and reported. Then it can confirm to you. It places a governance role on the behavior of managers, and that was something we looked at. And then we looked at other ways, valuation, compensation, how it could be used in compensation, how it could be used. And then now, so we started with the bottom line net income number, then we went up the income statement, right? And now we're like, whatever, everything that's in the financial statements, let's find out how it's used. Disclosure, okay? So not only in the footnotes to the financial statements, but anywhere in the 10K, anywhere in the financial statement, the annual report, like, what can we learn about the disclosure? Because accounting is information that's being disclosed, and how does it translate into market outcomes like stock returns, volatility? Like when we produce a new standard, does it make things better? Does it make things worse? And that's where we are now in this, because as technology has evolved, we can analyze bigger data sets. We can do fancier statistics. We can get information we couldn't get before, and that's what we're trying to incorporate now. In fact, the most recent papers are using like machine learning to try to say, can I take all the disclosure the firm makes, as well as what is out there in the macro economy, and predict what's going to happen over the next 12, 24 months? And can I do it better than like Wall Street analysts? Can I do it better, or at least as well as those guys? And that's what we're doing now, to try to figure out how good is accounting disclosure relative to having to have a conversation with an executive. So a common thing that I think people say about accounting research, and I have said myself, especially before I got into it, is, well, who cares? Like, I mean, nobody reads your research except other academics, and it's got all these symbols and math equations in it. And so, like, how, if you wanted someone to read it, the reason they don't read it is because they don't understand it, because you use all these weird words. And I will say that in the end, that's not really true. Regulators do care about it a lot in the United States. We have 7 people on the FASB, the Financial Accounting Standards Board. One of them is an academic who did this for a living, who wrote research papers. Their goal is to bring the findings from the research that, of course, not everyone can understand because of the symbols and the math and all that, but they distill it down into like, hey, here's what they found, and it may be useful when we make a decision. The SEC, the Securities and Exchange Commission, they hire several PhDs that do the same thing. In fact, the SEC chief economist, S.P. Cathari, recently is super famous accounting researcher, top editor at an accounting journal. And so they clearly care about it there as well. My research has been cited by the FASB and the SEC. And since 2014, the FASB has an annual conference that I go to, where we literally interact with, here's what they're thinking about, here's what we're doing in academia, and how can we inform each other, not only at the conference, but going forward in our research agendas. And so that's how I think, while it is true that they're probably not reading the papers directly, they are getting them translated into ways that can help them make decisions at the regulatory level. Practitioners, same thing. I mean, they receive accessible descriptions of the stuff we do through either practitioner-oriented journals, like we have, Accounting Today or CPA Journal, and media coverage. Okay, so like, it's not going to be the article with all the math in it and all the equations, all the statistics, but it will be a carefully written description of what they did and what they found. And then hopefully that helps you. And so I think, that is something to just keep in mind, that, like, while it's true that nobody's going to the academic journal to read it, there's a whole group of people who read those, who are aware of how to read those journals, and then bring them into practice where they can be helpful. So now at this point, I just want to illustrate the title of the presentation, how financial reporting research can help make teaching better, regulation better, practice better. And I'm just going to use it through the things I've done. and observed during my time in practice. And so the things I'm going to focus on today are accounting and reporting of derivatives, accounting and reporting of risk factor disclosures, and accounting and reporting of pension plans. These are three areas that I have done research in that I believe have made my teaching better, have had some impact on regulation and practice. Okay, so let me start with derivatives. So I worked for this company called Remington Arms Company in the United States, and they make rifles, shotguns, and ammunition. Okay, and a key input to a rifle or a shotgun or ammunition, in order to make something like that, you need brass, copper, lead, and steel. These are raw materials. You have to have them. During the mid-2000s, prices for brass, copper, lead, and steel were just skyrocketing. And there were a bunch of arguments as to why that was, but it was the truth. That was what was happening. And so Remington had to pay a lot higher prices for the stuff that went in the raw material, the cost. So obviously the cost of the guns were going up, and we had to try to pass that through to our customers. We couldn't, because at some point people are just gonna not buy a new gun; they'll just buy an old one off the internet. But regardless, even if we could pass it all the way through, there was going to be a time lag. We couldn't just be like, well, we paid 30% more for brass today, so our guns cost 30% more today. That's not how it worked. So to manage that issue, we would buy derivatives that would make money when the price of brass or copper or lead went up. So it'd be like, look, yeah, the brass, copper, lead prices are higher, but we have this contract that made gains when that happened. And so we reported that we had these gains in the financial statements. And but I mean, like I'm saying, there was some big changes during this time window, and I was the person preparing the financial statements and preparing the CEO and the CFO for having to talk to analysts about what these rising prices meant for Remington. And they would, the analysts would be like, yes, it's true that the costs have gone up, but you guys look like you're good because you're hedged, so don't worry about it. And I remember leaving I left the room that we were in with the CEO and the CFO, and I said, these guys don't get it, because they don't understand that it is true that these were good. They protected us from the rising prices, but they only last for 9 months. And after the 9-month window, if prices if they stay where they are, we're screwed. We're gonna have to pay that high price. And it's it seems like they don't get it. They think that we've somehow figured out a way to not pay higher prices for brass, copper, lead, and steel, and we haven't. All we've done is delay that, relative to our peers because of this hedging. And the CEO is like, yeah, I don't think they do get it. And so that led to this a realization that the financial statement, the people reading our financial statements were like, you got a gain, this is a good thing. And we're like, it is true, it's good in the short run, but in the long run, it's not good, because it's only temporary. It's only a temporary protection, and it represents that actually our underlying prices are going up. And when that protection rolls off and those higher prices are having to be paid, we're going to have a bad gross profit, a bad net income, like all of our other peers who didn't hedge. And so this led me to think well, would it be true that firms with very large derivative gains, in the short run, that's good, but it means in the long run that whatever they were hedging, the prices went against them. And so in the long run, when that protection rolls off, are they going to have lower profits? So my question was, if you see a firm with a large derivative gain, that probably means bad stuff in the future is going to happen. And the same thing with a derivative loss. If you have a loss, that means what you were hedging went in your favor, right? That you would have been better off not hedging, honestly. But what that means is when that rolls off, you're going to benefit from that. And so you'll have higher profits. And so, first of all, I wanted to know in my research, is that true? Is it true that if you have large derivative gains, I can predict that you're going to have lower profits in the future? And if you have large derivative losses, I can predict you're going to have higher profits in the future. That should be an economic fundamental question that analysts don't appear to get that relationship, but I just wanted to know if it's true, because I thought it would be. And you have to make some assumptions about underlying price behaviors, but yeah, that's pretty much what I tested. And then the next question was like, well, if that's true, then when do investors understand that relationship? Do they get it right away, or are they like the analysts we talked to and not price it right away? And if they don't price it right away, can I predict the future stock returns? And all of this is to say, is the accounting really confusing? Because nobody understands it, right? And so in a paper that I had, this was the graph that the editor asked me to put in the paper, but just describing what I'm talking about, like basically, here we are at time T, and we're selling our product for $4 and it costs us $2. And so the net profit is $2 in current period. And also in the current period, we have this gain, this hedge that made $1, which means that the underlying thing we were hedging went up $1 in cost. Okay, so then in T+1, what would happen is, we still sell the thing for $4. Now, when we go out and buy it, we have to pay $3 because it went up $1. But we have this hedge, right? That brings that cost down back to $2 for us. So again, we're at the same $2 profit that we had in the previous period, because even though the cost went up $1 for the raw materials, we had the gain to offset it on the derivative. So we have a $2 net income. Well, the problem is that's only temporary. And then when you get to T+2, that wonderful offsetting gain is gone and you're still paying $3, and now income goes down. And so the point was, if you have a gain, it helps you in the short run, but in the long run, you'll see a decline in profits from $2 to $1. Okay, and so this the editor said, I like this graph, put it in, and she's like, I'm imagining people using this in an MBA class. So what did we find? Yeah, I went and looked statistically. If these are changes in gross profit, if you had a hedging gain, then what you would see is a decline in profitability. And if you had a hedging loss, what you saw is an increase in profitability over the next year. So it was true. It was true that gains led to lower profits 2 years later, and losses led to higher profits 2 years later. And then the question was, when does it get priced? Is it priced right away? Or and then it was like, well, why would they be confused? Well, the accounting is weird, because the derivative is recorded on the books right away. The underlying purchase of brass, copper, and steel doesn't happen until in the future. One is recorded at fair value, the other is not recorded at all or even disclosed. It was called the mixed attribute model, is what it was called. But basically, like, the accounting is kind of like partial information. And I just felt like, people probably didn't fully understand what was happening. And that's why I thought that they wouldn't price it right away. And that's what I found, is that, so I have, like, you can see here, 4 different research papers on this topic. And what we found was that, like, equity markets didn't get it. And you could do a trading strategy. You could, if you sold short the firms with the largest derivative gains, and you went long in the firms with the largest derivative losses, you made money. You made 10% returns, arbitrage free, 10% returns over the next annual 10% returns over the next 2 years. And then we said, okay, well, so that's the stock market. And then we're like, well, what about analysts? They're supposedly sophisticated capital market participants. So maybe it's a risk-based explanation, but if analysts don't get it, then it's probably a human misprocessing, kind of don't understand it. And that's what we found there, is like, when you had large derivative gains, in the future, these analysts that were predicting the future overestimated what the future earnings would be. They made predictable errors based on this relationship between the accounting variable and future profits. Debt markets do the same thing. There was predictable pricing, mispricing there as well. So then it's like, okay, you've identified that the accounting for this variable is confusing a little bit and that people don't price it correctly. How can we fix it? Well, one way to do it, and by the way, the FASB was aware of this. They were concerned about this the day they set this type of accounting up. But one thing you could do is like better disclose what it is, when it's and the timing of it, that it's only temporary, and what might happen in the future when it rolls off. And sure enough, like the FASB enhanced their disclosure requirements in 2008. And then I wrote a paper showing that after that happened, the mispricing went away. And so everybody understood it now. So the point is that to the regulators, they were like, okay, we did this thing where we made the account, we knew it wasn't perfect, but we put the accounting out there in the initial way. It did lead to some confusion. And so now that we've enhanced the disclosure around it and people are more aware of it, it's not a problem anymore. And that's where I think our research helped them. They can move on to other things that are more of a problem because they don't have to worry about this as much anymore. So how does this example, how does it help teaching? Well, like I said, that figure that I presented is used in MBA classes, and it's also in a textbook. So that's how my research can help me in the classroom and help you in the classroom, is the stuff we do ends up in textbooks and usually provides visuals to help people understand how accounting works. It helped regulators because it validated that their model is fine, because the disclosure can make things better. And it helped practitioners because stock prices are more efficient now. They're not. And my CEO and my CFO can now talk to analysts a little bit more clearly about what the derivatives do, that they are good, but they don't protect you forever. And that we are going to have issues in the future that we can't do anything about. Okay. And so it makes that communication process easier. All right. Next topic that I want to talk about is risk factor disclosures. So this is in 2005, the SEC. So now, we're talking about the SEC, required firms to add a section to the 10K that says, these are the biggest risks that we face. And it's a little weird because in that section, the firms don't have to tell you the likelihood that the risk would happen, or if it did happen, what it would mean. So it's like, hey, let me tell you a bunch of stuff that could happen to me. And it almost read like, don't sue me. I've told you all these, if they happens, I told you about it, right? But like, how useful is that? And I had to write that for Remington, and I thought it wouldn't. I actually thought it would be useless. I was like, I don't get it. Like, I'm basically going to tell you about a bunch of things that could happen. I'm not going to tell you how likely I think that they are to happen, and and if they do happen, I'm not going to tell you what they would mean to the future of my firm. So how can that be helpful? It seemed to me like it was going to be a big cover your butt for lawsuits kind of thing. And so I just want to know, look, the SEC is making firms do 10% of their filings devoted to this new thing. And like, is it helpful? Like, I don't think it would be. And that was the question I wanted to know. And here's an example of Coca-Cola's risk factor disclosure, just to give you an idea of why I don't think it's that helpful. And by the way, I am drinking a Coca-Cola here today, as you can see. Coca-Cola is in Georgia. They're headquartered in Atlanta. So this is my company. But yeah, so their risk factor, like, look at, these are the first two risk factors that Coca-Cola has. If people are worried about their health, they might not buy soft drinks. I mean, you knew that, right? Like, how is that helpful? Of course that's true, right? Like, I mean, why would I care about that? The second one, if water is scarce and as a poor quality, then we're going to have a hard time selling soda. Okay, again, how is that helpful? I mean, if the world runs out of water, I agree, Coca-Cola will have a hard time selling soda, but I also think we're more worried about things that are more important than Coca-Cola's stock price, right? So I don't understand how this is necessarily helpful. But what we did was we took software that went in and broke up the 10K and started at this new disclosure and ended at the end of it, and read the whole thing into some software. This is what we call textual analysis, because it's mostly words, not numbers. Again, they don't really tell you, like, you know, the likelihoods of that would happen or anything like that. And the machine would read the entire section, and then we use this thing called LDA, latent Dirichlet allocation. It's a type of machine learning. It basically it's called content analysis, where these are the most common words that were in that section, and it came up with a list of like 300 words. And so it said, like, across all the 10,000 filings that you analyzed, these were the most common words that showed up in the risk factor section for all these companies. And then we went through that list systematically, and we classified those words as either relating to leverage, litigation risk. These are all risk words, right? So it's leverage risk, like we could default on our debt, litigation risk, tax risk, and then the ones that didn't fall into those three categories, we labeled as other systematic risk or other idiosyncratic risk, meaning it's a risk that everybody faces, or it's a risk that's unique to that firm. And then once we had the types of risks that were being disclosed partitioned into these buckets, we started counting the number of words that firms were using at the firm level. How many words did they put in their risk factor to kind of tell, these are the topics they're talking about. Okay, so how many topics did individual firms talk about, and the percentage of the words that they had in that category that were driven into certain risk areas. And then what we did is we asked, if a firm is if the financial statements kind of indicate that they would have higher litigation risk, do they spend more time talking about litigation risk in this disclosure? And we found that was true. And if the financial statement said that you have lower taxes, do they spend more time talking about tax risk in this disclosure? And that was true. And if the financial statement said, if you have more debt, do they spend more time in this disclosure talking about debt? And that was true, and so on. And so the point was, I was wrong. I thought these things would be meaningless, but it turns out that if you're a machine and you can read 10,000 of these at once, you can figure out meaningful differences between the risk factors that managers disclose, because they do kind of correlate with what you would expect given the financial condition of the firm. They are meaningful. They are not meaningless. Okay, so now the question is, I was wrong about that, so I wouldn't price it, but does the stock market price it? Does the stock market realize that it's meaningful? And it turns out they do. So apparently somebody out there is reading 10,000 of these things at a time and seeing the difference. Or we just think in an efficient market, people can see these small changes that humans have a hard time detecting, and they end up getting priced. And so the point is that not only do managers provide meaningful risk factors, but they seem to be incorporated into capital market processes. And we presented this paper at a conference, and we sent this paper to the SEC. They appreciated it because people were kind of giving them a hard time about. I guess people who thought like me were like, this is a meaningless disclosure, and it's a big disclosure. It's like 10% of my document. And if we're worried that it's disclosure overload, for investors, this thing is not helpful. Well, we were kind of saying maybe it is. And so how did this help? It helps the teaching because I'm able to discuss these disclosures, how it can be useful, even though it seems like it might not be. And I can talk about this in my class when I'm talking about raising capital. It helps the regulators because it validated to the SEC that this new 10K section was useful, despite the criticism that many people were leveling against it. including myself. And then it helped practitioners because they were able to know that their risk factor disclosures could be useful. Also, it kind of helped, I think, people realize that if they weren't already doing it, that you could absolutely use textual analysis to read firms, textual disclosures and realize how the markets were going to move as a result. Okay, last one, and then I think we're supposed to stop for some Q&A. Pensions. So there were two, in the early 2000s, firms had a lot of these pension plans where they promised that, if you work for us, we'll pay for your retirement. And the problem was that in 2001, basically it was right after the internet stock bubble had kind of burst, and we had 9/11, September 11th here in the United States, where the economy kind of just stopped. So the stock market was going down, and the government was trying to stimulate the economy by lowering interest rates. And those two things had a massive impact on the pension for firms that had a pension plan, the liabilities that firms would have to report, because the liability on the books, if interest rates go down, the promises, the net present value of the future cash flows go up, right? And the liability is, the pension liability is the net present value of future cash flow. So when rates go down, the liability was going up just because of that. When the government lowered rates, pension liabilities went up. But the other thing is, you're also allowed to offset that liability with any assets you've set aside to make those pension payments. But at that time, the stock market was going down. So it was like a double whammy. These liabilities were shooting through the roof because the interest rates were going down, and the assets held to sort of keep the firm from having this big liability were going down. So the government was actually quite worried that all these companies that made these pension promises were just going to bail on the pension plans. They were just going to, just not pay them. And obviously, if that happened, that would be bad for the economy, because you have a lot of citizens that built their life around expecting these retirement payments, and the government was going to have to take over, for that problem. So what they wanted to do was make the accounting more transparent for the pensions, and then they created this thing called the Pension Protection Act to try to encourage firms to pay their liabilities faster, so that if they did bail on the obligations, if you pay faster, your liabilities will go down. But also, if they bailed on the obligations, the government wouldn't have to make up as much of a shortfall. And so what we did was kind of look at, so this was just describing the problem. Like I just said, you can see that right around, in the 90s, 1990s, late 90s, everything was fine because the market was doing well and rates were fine. And then right around 2001 is when the liabilities just sort of shot up, they went up, 25% or more, because the rates were going down and then the market prices were going down. And this is a graph showing that how many firms went from being funded in their pension plans to being severely underfunded because of this change in the market. And then this is what precipitated these regulatory actions. Well, what did we find? We found that in terms of, so there were two things that were done. The FASB made the liabilities, they put them on the balance sheet to be a little bit more transparent. Nobody cared about that. They already knew that liability was there because it was disclosed in the footnotes. So the act of moving it from the footnotes to the balance sheet didn't seem to have much of an effect. But this stock market regulation the pension regulation that said you guys have to fund your thing faster, that investors were not happy with that, which is fine. But just the point is, by doing that, again, the government was worried these companies were going to bail on their pension obligations, so they wanted them to pay more attention to them. And when they passed that law, the stock price for firms that had pensions went down by 4%. And this was a bigger deal for firms that had more of a pension problem, or where this funding would hurt them worse. And one of the things we realized was that the people who are going to get hurt the worst in this were firms that needed to use that cash to invest in, capital expenditures and future investment projects. This law basically made it so that they didn't have the ability to do that so easily. And then we also documented that, in fact, this law did exactly what you might expect, is that if you're going to tell me that I have to start funding this thing faster, I'll just stop giving a pension. And so a lot of firms just quit giving pensions as a result of this. And so the point was, like, it has real world, when the government makes regulations, that they're good regulations, they're intentional, and they're necessary, but they also have consequences, and we were documenting those consequences. So how it helps teaching, because these graphs I showed you were presented in several classes. It helps regulators realize that there are real effects of what they do. They may be aware of that and they're comfortable living with that, but it does make it clear that when they make regulation, that there's a side effect. It helped practitioners, because we actually wrote a practitioner article about this, saying, hey, here are the changes. This is what we're seeing that investors care about. And here are some ways for you to help navigate it. And just recently, the state of Georgia asked me to be on a pension consultation committee because of this paper. So I'm able to help practice there as well. So anyway, I think at this point, I probably need to stop for Q&A, but I do want to, last thing I'll say is, I think the process of writing a research paper is helpful. So even if the topics you research may not end up helping regulators directly, I think it disciplines the way you think about things. It forces you to be specific and careful with your language, and these things make you a better teacher. So that's another way it makes the academy better, education better. Also, all these things I just told you about use data, statistical analysis, big data, and these are skills that the new economy wants. So if I can learn how to apply them, I can make them better. I can teach them better to my students, and they can use them better in their work life. And I think that's the new economy that, investors, hedge funds, banks, audit, they're all gonna need these skills that we use when we do our research. So my overall point is, I think our research, if you devote time to financial reporting research, it'll make you the better teacher. It can have help to regulators, and it can help improve practice. So now the last thing I'll say is, I finally have an answer when my wife's dad says, "What do you do for all the months that you don't teach?" Here's what I do when I don't teach. I do research. I hope that this has been helpful, and now I'll open the floor to any questions.
So thank you so much, John, for your very interesting presentation. It was very, very important for us, especially because it's focused on a market based on account research. I suppose that it's a very interesting indication of how accounting research, more specifically financial accounting research, can be useful for regulators, for the users of the account information. It's very, very interesting because you showed us that 3 different papers that you prepared in the past. But nowadays, I suppose that you are more focused on academia than the market. I'm supposed that you're not participate as a practitioner or a regulator. What do you do to keep your mind focused on really important topics to be researched, to be translated in financial accounting research? If you can share with us a little bit about this experience, it will be very helpful.
So how do I come up with ideas to research? Well, so like I said, we have an annual conference with regulators, and they talk about issues that they care about. One of them is, the use of fair value in financial statements and whether it's helpful. So for example, that's a new project I'm working on because of that conference I went to, and hearing I basically look for anything that I hear people say the accounting is confusing or not helpful. And I just try to say, well, is that the case? That's basically what I keep my ear out for. And then those are the kind of papers that we write. And then also sort of how does the accounting, because I mean, we were just talking about this yesterday with a colleague here, is like, once you set the rules up for the accounting, this affects how people behave. So then like also seeing like what the consequences are to new regulations. I mean, I think that's basically, and new regulations happen all the time. And so that's basically how I come up with ideas.
It's very close to the economics studies that still is on the new public policies. For you would like to see the before of the regulation, and it's very, very interesting. Sometimes, as you showed in the second paper that you presented about the risk factor disclosure, we needed to translate some qualitative events, some qualitative situations to a quantitative measurement or metrics, like, for example, several different papers that we have in accounting, and of course that we need to pay attention to research design related to this project. How many time do you expend in a project, a paper project, about research design, or to try to create some tests, some statistical design to try to capture, to isolate and to capture a specific event? How do you do that?
That's a good question. In fact, in that paper, it was we started it in 2010, and I knew I had no idea how to do that. And so we actually reached out to people in the MIS department or the systems department to help us do that for us. In fact, we just co-authored with them initially, and they brought those statistical abilities, and we brought the accounting knowledge with us, and that's how we teamed up to do that. Now, obviously, I had to learn what they were doing, but at the high level, and not in the actual programming kind of thing. Well, since then, that's something I've been trying to keep up on, and it's hard because technology is moving quickly. But for example, this week and next week, I'm sitting in a training class to learn the newest methods for how to turn qualitative data, the unstructured qualitative textual data, into quantitative stuff that you can analyze. And that's like, it's a struggle for all of us to keep up with how technology is moving. But I think the best advice I would have is you got to start somewhere. So pick a time, learn it, and then everything after that will be a little bit easier because you'll have a basis for comparison of how things are evolving.
Right, very. We're facing the same challenges to translate qualitative and quantitative finds.
Yeah, it's hard.
Yes. We have a question from our colleague here, Professor Josué Braga. Is there any documented evidence that the regulators are cherry-picking research papers to support their political position?
That's a good question, and sure. I mean, I don't know if there's any academic evidence, but I would, of course, you would think that that regulators are also subject to human behavioral biases, where you're more likely to believe things that that fit with your worldview, and you're less likely to believe things that don't fit with your worldview. And academic research is no exception. I think that one of the benefits we have is open process, peer review, and then open debate. And so if you think that a regulator is doing that, you can go and write like we've written comment letters before to the regulators to say, hey, like, here's what you may see that paper that says this, but here are these 6 other papers that say the other thing. And so that's just how you have to try to, change minds. You may not change that person who really doesn't want to listen, but if it's a public process, the rulemaking is a public process. And if there's anybody that can be swayed, then hopefully you can sway them if it's important and necessary. So yeah, I mean, unfortunately it's messy, like regulators don't always follow what we say, and they not necessarily should they. I mean, our research presents certain findings, but their objective function as a regulator is different than ours, and maybe they can live with what we're saying because they're more worried about something else, and so we just kind of, but yeah, it's not as straightforward as, oh, I found this, look, regulators, do what I said. It doesn't work that way.
Yes. I know that because nowadays I'm a member of the advisory council of the IFRS Foundation, and the International Counselors Board, as that FASB also do, also promotes and supports some academic research. And they use this evidence, they use these findings to create some new discussion papers or exposure drafts, for example, but it's not explicit, it's not clear that they are using this information. We know that because we see this process, we understand this process, but the public audience is not clear that this find comes from that paper. There is not a citation.
That's right. I mean, the things they like the most are when we write papers that say what they did was good. So if we can do that, then they love us. But other than that, it's a slow process. Yeah.
Yes. Considering our time and our schedule, Professor John, I think that we have time for the last question. And I think it's very important for our audience, especially because the largest part of our audience are scholars, accounting scholars. And as you said before, the paper's finding, the paper's ideas to share these ideas and these findings with your students, even MBA, postdoctoral, postdegree students, and undergraduate students also. How do you do that? What kind of tools do you use to share this academic research world university with the undergraduate students?
So, like I said, I think most of my papers, I try to do some kind of visualization with the data, like to show this was the problem we were trying to address, and so there's usually some kind of graph or some kind of photo or figure that demonstrates a problem or shows how things changed. And that's usually the easiest way I've found. That it just fits into when I'm teaching pensions, I talk about X, Y, and Z. It gets people to realize that this stuff has real world implications. It's not just some textbook I have to memorize. And then I think, and I look at other people's research in the same way. Like if they have a graph or a figure I can use, I bring that in if it relates to a topic that I'm teaching. And then sometimes those figures and graphs get put in textbooks, so then they see them outside of class. But that's how I do it is, and I don't spend, we have to talk about accounting. We don't just talk about our research. I don't spend the whole time talking about my research, but it's really usually a couple of minutes to say hey, here's something that usually the papers we write describe the world, and here's something that you might this topic is usually as a way to say this topic is a relevant topic, and I'm not just teaching this because it's a box that I have to check on the syllabus. And so yeah, and then I've heard friends of mine at other universities say, hey, I saw your paper and I use this in my classroom. So basically that's how I bring it in, just a couple of minutes to help motivate a topic.
Great. Very, very interesting. And I also agree that we needed to do it more, to try to use our research to be in class, to teach for our undergraduate students, especially to create this mindset that is necessary to link the research and the practice of the financial accounting.
Yeah.
Professor John, thanks so much for your kind acceptance to attend our congress, our conference. It will be very, very good to receive you in person with us in the future. And thanks a lot for your kind and very interesting presentation. Thank you so much.
Well, thank you all very much. And feel free to email me if you have anything you want to talk about afterwards that we couldn't address during the presentation. So, thank you. Thank you all.
Bye-bye. Thank you so much.